Hello everyone, welcome to Chetan Bharat Learning and welcome back to our weekly current affairs series in which we'll cover all the important developments with respect to the field of Indian economy for your UPSC preparation. Now, the Indian economy related current affairs that we are going to cover in this particular video would be from 23rd of November to 29th of November. So let's take a look at the issues or the news items that we are going to cover in this particular video. Alright, issues to be covered. Number one, RBI's internal working group came out with a recommendation that corporate houses should also be able to or should be allowed to establish banks. Right? Now, this particular recommendation of RBI is being criticized across board. All right? All the experts with respect to the field of banking sector, all of them are criticizing this particular recommendation of RBI. So, we'll take a look at this recommendation. Why did our internal working group of RBI came up with this recommendation, and what's all there to criticize in this recommendation? All right? So, corporate houses being allowed into banking. We'll study this. Then we'll take a look at banking health and the K-curve dynamics. Alright, in the previous video we covered Lakshmi Vilas Bank's moratorium. The RBI actually applied a 30-day moratorium on Lakshmi Vilas Bank because Lakshmi Vilas Bank, an old private bank, was not functioning well, right? So this particular news item actually initiated a spotlight on on the financial sector. Alright, so that is why we are going to discuss the financial sector in general and banking sector in particular. That's why there were different articles, and we'll discuss this particular article by Siddharth Vardarajan in Hindu in detail. Then we'll talk about China's negative yield bonds in demand. All right, China has actually issued negative yield bonds and they are in demand. Now, why are people opting for negative yield bonds? We'll take a look at that. Then we'll talk about addressing the issue of hunger and nutrition, public distribution system and all these things with respect to hunger and nutrition in India. We'll discuss that. And in the end, I'll give you certain articles that you yourself need to read because they'll be beneficial for your mains answer writing practice and essay writing. All right. So we'll talk about those articles in the end. Clear? So without further ado, let's begin with the first issue, corporate houses being allowed into banking. Now, this was such a hot issue that many newspapers actually published many articles with respect to this. Now, for this particular video, I have shortlisted 4 articles, 2 from the Hindu newspaper and 2 from Indian Express. All right. All 4 of these articles are important for your UPSC preparation, for your UPSC current affairs, and that's why we are going to confine our discussion with respect to this issue in these articles only. Okay, around these articles only. Clear? So let's start. Now, what's the news? The internal working group of RBI was recently set up to review the extant ownership guidelines and corporate structure for Indian private sector banks. Now, what has happened is that the banking sector is actually failing for quite some time. It is in a precarious situation. All right. Banking sector in particular and financial sector in general is actually falling. It's not performing well. Now, there are various arguments that are being presented to explain why this is happening. Now, many people say that the ownership structure of Indian banks plus the governance structure of Indian banks is flawed, and that is why a crisis-like situation always repeats itself periodically. Clear? So therefore, RBI actually set up an internal working group to advise or recommend certain reforms in the ownership structure. All right. This internal working group came out with a set of recommendations, and among those recommendations, all the recommendations were all right, but one particular recommendation was extremely controversial. What was that recommendation? Let's take a look. Recently, the IWG submitted its report, which became quite controversial because one of its recommendation was to allow large corporate houses to be promoters of private banks. Currently, in Indian banking system, corporate houses who are not involved in financial businesses. Now, there are various businesses, there are various corporates. Some corporates are involved in financial businesses. Financial businesses means that there are broker firms, that there are various NBFCs, then there are various, venture capitalist funds, then there are various hedge funds. All these are financial businesses, right? Financial corporate houses. Now, there are various non-financial corporate houses. For example, Reliance Jio, Adani Cement, Birla Cement. All these people are actually doing business in the non-financial side. Financial side would involve transaction of money, transaction of money, and they earn money out of it. Clear? You understand the financial side. Lending or borrowing money is financial. Buying and selling equities, that's financial. So those companies whose main business is that, lending and borrowing money, buying and selling of securities, those are called financial firms, and the other businesses are called non-financial. Now, RBI in its internal working group actually recommended that non-financial businesses should also be allowed to set up banks. Earlier, the condition was that if anyone wants to set up a private bank, then he should not be from the non-financial side, he or she or that particular entity. Only financial business houses, those who already have a non-banking finance companies, they are allowed to set up private banks, but not non-financial business houses, because that creates a conflict of interest. But internal working group IWG through RBI has asked or has recommended that corporate houses should also be allowed to set up private banks. Why did they do that? Because their argument is that if they'll allow corporate houses, non-financial corporate houses, to set up private banks, then there will be growth in private banks. Number of private banks in India would increase, and India requires private banks because public sector banks have a very poor governance structure. They are least cost efficient, they are highly inefficient, and their governance structure is very bad. On the other hand, private banks have a better governance structure. So if we promote more private banks, then India's overall banking sector would become, or banking system would become, more efficient, right? So that is why they said that even corporate houses should be allowed to set up banks, because that would increase the number of private banks in India. Now, various economics expert like the former governor of RBI, Raghuram Rajan, and former deputy governor of Viral Acharya have criticized this recommendation. What did they say? Former RBI governor and deputy governor severely criticized the suggestion by the IWJ, describing it as a bombshell. They say that if this recommendation goes through, government accepts this recommendation, then India's financial sector would become highly unstable and more vulnerable to shocks. Clear? Plus, they use another line which can be beneficial for you to write in your mains answers. They said that it would be penny wise and pound foolish. What does this phrase mean? Penny wise and pound foolish. Look, every move, every policy move, or every recommendation has its set of pros and cons, right? Advantages and disadvantages. Now, Raghuram Rajan and Viral Acharya say that the advantage of this move is very little, but its disadvantages, its cons, are extremely high. So their advantages are worth a penny, but their disadvantages are worth a pound. All right, a pound is more than penny. All right, so that is why if IWG or RBI is trying to do certain things, they want to make the governance structure of Indian private banks or Indian banking in general, they can use this move. But this particular move would only slightly improve the governance structure, but it would come with its set of challenges and problems, and that would make our financial sector highly unstable. All right. So what they say, to replace the poor governance under the present structure of these public sector banks with a highly conflicted structure of ownership by the industrial houses. Now, what does the word conflicted means? They say, for example, let's suppose Reliance Jio. If this recommendation goes through, then Reliance can also set up its own bank. Now, Reliance will set up its own bank. And you know how a bank functions. There are deposits. People deposit their money in a bank. And banks use those deposits to loan out money. Now, don't you think there is a conflict of interest? Because the borrower and lender can be the same entity. Reliance owns a bank, and Reliance can also borrow from that bank. Do you think there will be a conflict of interest? Is that good governance? That is extremely bad governance when there is a conflict of interest. When borrower and lender have similar interests, or they belong to the same parent entity, then that's a big conflict of interest, and that is very, very dangerous, because all these risk assessment that banks do, before doling out loans, they properly do a risk assessment of a borrower's profile. All right, they want to check whether this borrower is legitimate. They want to check whether this borrower would pay back money, right? Because banks don't want to increase their NPAs. Make sense? Now, banks won't do proper know your customer, banks won't do proper KYC, banks won't do proper risk assessment when it would come to Reliance, if this particular bank is set up by Reliance itself. So there is a conflict of interest, and that is bad governance, and that is highly dangerous. That would make banking sector more vulnerable to shocks. And that is why Raghuram Rajan has criticized this particular move. Currently a promoter, this is the current system. There are only financial business houses can set up a bank. Non-financial business houses cannot set up a bank. All right. If IWG's recommendation is implemented, it will allow corporate houses whose non-financial activity is greater than 40% to open banks, and that would create a situation of conflict of interest. All right. Now, what is the main risk with this thing? The main risk with this recommendation is that of connected lending. Now, what is connected lending? Connected lending is a situation when borrower and lender have similar interests and they belong to the same parent entity. That's what connected lending is. That borrower and lender are one and the same person or entity. It is a situation in which bank's controlling owner extends loans of inferior quality at lower interest rates to himself, because he's the lender and he's the borrower. But whose money is being utilized? Depositor's money is being utilized, right? Lender is one person, lender and borrower are one and the same entity. But money or risk is being transferred to the depositors, right? They're using depositors' money to lend, right? And they're lending that money to the same person. They're lending it to themselves, but the money is coming from depositors. That's why depositors' money becomes risky. Their deposit becomes risky, or I should say vulnerable to financial shocks. All right. Under such a situation, it becomes possible for a promoter of a bank to channel the depositors' money into their own ventures. There is also a risk of evergreening of loans. Now, what is evergreening of loans? When you take loan to pay back a previous loan that you have taken, that's called evergreening of loans. All right. When you borrow to pay back your earlier borrowings, that's evergreening of loans. That's never allowed. Banks always discourage that. Banks do not extend loans that cover earlier borrowings. All right. They don't extend loans for covering your borrowings. Clear? They extend loans for a particular venture. That's what happens in KYC and risk assessment. But if lender and borrower are one and the same thing, then those risk assessment studies won't be done, and evergreening of loans would become more rampant, right? And that's very dangerous. Evergreening of loans is never good because it creates a debt bubble and makes your financial system vulnerable to shocks. Past examples of such mingling, right? Previously, Japan and South Korea tried this thing and they failed miserably in the East Asian crisis of 1998. Therefore, India should learn from the experiences of Japan and South Korea. All right? Now, why was IWG constituted? What was RBI's logic in constituting this particular internal working group? Now, why, the reasons given for its constitution take us back in the history also. All right. So during the time of India's independence, banks were privately owned, resulting in large concentration of resources in the hands of few business families. Now, India does not want to concentrate wealth in fewer hands. That's why India, way back in 1969 and again in 1980, nationalized private banks. Now, what do we mean by nationalizing them? We mean that all the private banks were forcibly put under government control. Indian government nationalized those banks, right? To achieve a wider spread of bank credit, prevent its misuse, direct a large volume of credit flow to priority sectors, and make it an effective instrument of economic development, the government went for nationalization of banks with After financial liberalization in 1991, the economy's credit needs grew and private banks re-entered India's financial landscape. Then, despite financial liberalization in 1991, there are still various issues that need solution. Despite 1991 financial liberalization, despite Narsimhan Committee recommendations, there are still issues that languish in India's banking system. What are those issues? Total balance sheet of banks in India still constitutes 70% of GDP. That's very low. Compare this with China, and Chinese banks have a balance sheet of 175% of Chinese GDP. That's very low. That means Indian banks are not disbursing enough credit to fuel India's economic growth, right? China is doing that. but not India. Domestic bank credit to private sector is just 50% of GDP, whereas South Korea, Japan, China, US, their percentage is 150%. That's very low. That means, plus there is only one Indian bank in the global top 100 by size. Indian banks are one of the least cost efficient, especially public sector banks. In other words, India's banking structure is struggling to meet the credit demands of a growing economy. Therefore, IWG or RBI has said that even corporate should be allowed to set up banks, because that would increase bank credit and that would increase credit demand, or that would satiate credit demands of these corporates, right? Because they require credit to allow India's economy to recover. But right now they are not getting credit because currently banks are suffering from NPAs and they have become more risk averse. That is why they are not extending enough credit. Right? Because they are not extending enough credit, the current banking structure is not extending enough credit, there is a situation of financial crunch with all these corporate houses. Therefore, RBI has said that these corporate houses should not ask for credit from these banks. They should set up their own banks. Hence, their financial requirements would be satiated through deposits of the public. Clear? Also, PSBs have a dominant share in the financial market of the country, whereas private banks are not only more efficient and profitable, also have more risk appetite. It is in this background IWG was asked to suggest changes that not only boost private sector banking, but also make it safer. Alright, now let's take a look at the pros and cons of this move. You need to know both, because if there is a mains type question that is asked to you, then you need to know both advantages and disadvantages of this move. So what are the advantages of this move? In India's economy, private sector needs money to fuel India's growth. Far from being able to extend credit, PSBs are struggling to contain their own non-performing assets, and that is why they're not being able to dole out credit to these financially hungry corporate houses. Government finances are also in doldrums because why? Because government's fiscal deficit is stretched beyond its stretched to its maximum, right? Government, because of its Atmanirbhar Bharat package and various other stimulus packages, government's fiscal deficit is stretched to its maximum. It cannot fuel economic growth in India because their finances are pretty strained right now. So government won't do that. Then how would these financially crunched corporate houses get money? They'll get it through public deposits if they are allowed to access public deposits, and that will happen if they are allowed to set up their own banks, right? Thus, large corporates with deep pockets are the ones with financial resources to fund India's growth. The IWG's recommendation would also bolster prudential norms. Prudential norms, that means prudential norms would be regulatory requirements that would. Now, current regulatory requirements are not that stringent to prevent fraud, right? But RBI, along with this particular recommendation, IWG has also suggested various other recommendations which would make regulatory norms more stringent, so that it would be very difficult for a corporate house to game the system, all right, to find a loophole and exploit the system. All right, now what are the cons? Cons we have discussed already, so I won't repeat that again. Clear? Now let's move forward. K-curve dynamics. Now I am discussing this particular article that came in Hindu for only to discuss few terms, few economic concepts that would be very beneficial for you for your prelims preparation. All right. Now these terms, we'll only discuss this article to the extent of discussing those terms only. I am discussing this article just to make you understand those terms. All right. There are two terms, and that we'll discuss through this article. We won't get into the details of this article. We'll just understand two economic concepts that were mentioned in this article. All right. Now, one was price to book value ratio. You need to know what is that, because UPSC can ask a question on it, prelims type. And you need to know what a K-curve means. Clear? So let's take a look at both these economic concepts. Now, a key metric to judge the performance of a financial company, that is an NBFC or a bank. A financial company is can be a bank or an NBFC. A key metric to judge the performance, if you want to understand whether a particular bank or NBFC is performing well or not, you need to know its price to book value ratio. Now, what is price to book value ratio? First of all, you need to know what is market value of a share of a particular bank, right? There are various banks that are publicly listed and their shares are being traded in the stock exchanges, various stock exchanges. Now, each share has a certain market value attached to it. Whenever the demand for that particular company's share increases, its market value also increases. And when does a demand for a particular company's share increase? It increases when people believe or people have confidence in that particular company, that this particular company would improve in future, or this particular company would perform way better in future. Then only people would demand more shares of this company. And when people would demand more shares of this company, its market price of the share of that company would increase. Right? Does that make any sense? So if everyone in India feel, or if people participating in the market of buying and selling of shares, if all of them feel that Reliance Jio would perform way better in future, they would start to demand the shares of Reliance Jio. They would start to demand Reliance Jio shares. Now, demand for Reliance Jio share would increase. Now, as you guys all know, that if demand for a particular commodity increases, its price also increases. So if demand for shares of Reliance Jio would increase, then Reliance Jio's price would also increase. Right? Makes sense? All right. Now, what is market capitalization? Market capitalization is total shares multiplied by price per share. So if there are 100 shares of Adani Group and each share is priced at 10 rupees, then Adani Group's market capitalization is 1000. Now, what is book value of a particular company? Book value is total assets minus total liabilities. For example, I have a company and if I add all the assets that I have, physical assets like building, machines, land, if I add all these assets and subtract my company's liabilities from it, net asset, right? What are net assets? Total assets minus total liabilities. That is net asset value. So net asset value is also called book value. So book value would be total assets minus total liabilities. Ignore intangible assets for now. Okay. Now price to book value ratio would be market price per share, that in this case is 10 rupees, book value per share. Now let's suppose my net asset value of my company, which has 100 shares in the market. Let's suppose the net asset value of my company is 100 rupees. Let's suppose that, right? And I have 100 shares in the market. So my book value per share would be 100 divided by 100, 1 rupee. Make sense? So price to book value ratio would be this. Now, if your price to book value ratio is greater than 1, then that means market price of your share is high. That means people or market has more confidence in your company. That's why they're demanding your shares. But if your price to book value ratio is less than 1, then people do not value your company enough. People think that your company would perform worse or would perform badly in future, and that's why they don't want your shares, and that's why the demand for your shares is very low, and that's why the price of your share, your company's share, is very low, right? So that is what price to book value ratio is. Clear? Now, where does K curve come into the picture? How does K curve come into the picture? Price to book value ratio greater than 1 means the market believes that the company can grow and generate better investor return. All right. Vice versa for if it's less than 1. In India, some banks have a price to book value ratio greater than 4, whereas many others languish below 1. So there are some banks that have a price to book value ratio greater than 1. That means markets believe that these banks are good, they will grow in future. And there are many other banks that do not have, or those banks do not have the confidence of the market. That is why their price to book value ratio is less than 1. Clear? So right now the entire banking sector is going through a crisis. But market believes that there are certain banks, these banks whose price to book value ratio is greater than 4, they would rise to the occasion, they would improve their performance in the future. Right? But many other banks won't be able to improve their performance in the future. So if I map or chart out the performance of various banks on a graph, currently all the banks are performing badly. But market believes that some banks whose price to book value ratio is greater than 4 would perform better. Their performance would increase. And many other banks, their performance would decrease. Right? Now this is known as a K curve. Can you see? There is a curve of K shape. Some banks are performing well, some banks are performing badly. If the difference between the two extremes increases, then the distance between the two curves actually widens, right? So that is the situation with the banking sector. Among NBFC, the K curve is even wider. Why? Because there are some NBFCs that have price to book value ratio greater than 7, and many others have a price to book value ratio that is less than 1. So the K curve is actually more wide in the case of NBFCs. Okay? The banks that lie on the upper end of the K curve are called alpha banks, like alpha male, alpha banks, right? They are good banks. Clear? The growth trajectory of these entities, classic K curve playing out. And what is K curve? You can see from this diagram as well. K-shaped recovery of economy. Because of COVID-19 pandemic, the entire sector fell. But when all these financial houses are going to recover, the blue line banks would recover better than the orange line banks, right? Hence the formation of a K curve. And here's the definition. You will find this definition in your notes. All right? Make sense? All right. Let's move on to the third issue. Recently, China has issued various government bonds. And in some of those bonds, China is offering negative yield. So let's take a look at this issue. Recently, China sold negative yield debt for the first time. There was high demand for Chinese bonds in Europe. Now, why are Chinese bonds very popular in Europe? Why are European investors investing in Chinese bonds? Why? As yields in Europe are even lower than China, there was a huge demand for 4 billion euro bonds issued by China. Chinese bonds are offering higher yields than European bonds. If 5-year bond of China has negative yield, European 5-year bonds would have an even lower negative yield. China's 5-year bonds were priced at yield minus. Though their 10-year and 15-year bonds have a yield that is in positive territory, but their 5-year bonds have a yield in negative territory. But European bonds are offering even lower yields, and that is why European investors are trying to increase their exposure to Chinese bonds. All right. Now, what are negative yield bonds? These are debt instruments that offer to pay the investor at a maturity amount that is lower than the purchase price of a bond. Let's suppose I purchased government bond for 100 rupees. After 1 year, government would pay me back 97 rupees. That means I would incur a loss of 3 rupees. Now that 3 rupees would be minus 3 yield. My yield would be minus 3, right? These are generally issued by central banks and governments, and investors pay interest to the borrowers. The lenders are paying interest to the borrowers. In a sense, yes, if I'm giving someone money and they would actually deduct some money out of it and pay me back, that means I am paying interest. The lender is paying interest, right? That's the case with negative yield bonds. Why do investors buy them? If the lender is going to lose money, then why are lenders or investors buying these negative yield bonds? Well, in times of crisis, they have to. Whenever there is a recession-like situation, there is demand for negative yield bonds. These types of securities attract investment during times of stress, uncertainty, as investors look to protect their wealth from significant erosion. Because investors are losing wealth in various other assets significantly. They feel that if they lose some wealth in these negative yield bonds, it's going to be okay. It's going to be at least better than the other assets. At a time when the world is battling from COVID-19 and the interest rates are extremely low in the developed markets across Europe, investors are looking for better yielding debt instruments elsewhere to safeguard their interests. All right? Why is there a huge demand for Chinese bonds? Why is there a huge demand for China specific? Why not American bonds? Why not European bonds? Why China? Yields offered by China issued bonds are much higher than the European bonds. Simple reason. Then, many of the large economies, developed countries, are facing contraction in the GDP. Their GDP is contracting, whereas China's GDP is growing, right? One of the reasons is that. Then many European countries are facing second wave of COVID-19 infections, whereas China controlled its COVID-19 infections or COVID-19 epidemic in a better way. There is no second wave, all right? So China is performing well. Plus, global central banks have injected more than 10 trillion of liquidity. So people have more money because global central banks have injected so much money into the world economy that people have surplus money and they want to invest in various assets. Now, negative yield bonds are also assets, so they're investing in that too. That is why demand for these negative yield bonds is increasing. Clear? All right, there's a screenshot that I took from Indian Express. I have put it in your notes as well. So please read it out. It will help you. The wording of this paragraph would help you out in writing your mains practice questions. All right, mains type practice questions. All right, next issue is hunger and nutrition. There is nothing to explain in this, all right? I have actually summarized these two articles from Indian Express. So when you read your notes, you will understand each and everything. So there is no point in me discussing these issues, this particular issue. So I won't discuss it. I'm just giving you notes for this particular topic. But if you have any doubt, then please ask me. Please ask us through various channels of communication that are open to you guys. You can comment, or you can WhatsApp us, or you can call us for the doubts regarding this section. By the way, I have a feeling that you won't have any doubts when you'll be reading the PDF file attached to this video. You won't be having any doubts with respect to this section. But if you have one, then you can ask me. All right? Okay. So yeah. In the end, some articles that I want you guys to read it yourself, because, especially this article in the Hindu newspaper, because these articles would not only help you for your main answer writing, they would also help you, especially this article would also help you in essay writing. This particular article is that's a very good material for if you want to learn essay writing and if you want to improve your score in essay writing. So please read out these two articles. One was in the Hindu called Digital Nation on Delivery of Citizen Services, and the other was in Indian Express, What's Driving India's Economic Growth Worries. All right, makes sense? So that's it from my side, guys. I hope you liked the lecture. I hope various concepts and various economy related concepts that were discussed in this particular video are clear to you now. But if you still have any doubts, then please write to us, call us, WhatsApp us, do anything you want to, but do contact us if you want your doubts to be cleared. We are there to clear all your doubts. All right, so that's it from my side, guys. I hope you liked the lecture, and I'll see you next time with more stuff. Thank you.